So that's the interesting thing. CEOs have been calling, or many of them have been calling for some kind of recession, but they haven't been laying people off. And indeed, when we look at the share of companies saying that they're going to reduce workers, it fell from 20% to 13%. Meanwhile, you still have a large share, I think roughly 38% of companies that are saying they're still going to be hiring. And what's really outstanding in terms of it being very interesting is that those companies saying little change to their labor forces jumped from 40% to 49%. So that means that companies are still hiring those that, are still trying to catch up from the pandemic losses, or because they're having labor shortages, especially in manufacturing and construction, because you have these older workers retiring. But a ton of companies are just hoarding labor. They're just holding on to people because they think, well, if there is going to be a recession, it won't be that long, it won't be too bad, and we don't want to have to turn around 6 to 9 months later and try to rehire the people we let go.
You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of subjects that matter most to business leaders. To help make sense of these topics, we sit down with thought leaders and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Steve Odland from the Conference Board and the host of this series, and in today's conversation, we're going to discuss our measure of CEO confidence, which is a quarterly survey by the Conference Board of over 100 CEOs to gauge their sentiment on the economy. Joining me today is Dana Peterson, our chief economist and the leader of our Center for Economy, Strategy, and Finance at the Conference Board. Dana, welcome.
Hi, Steve.
So Dana, explain this survey for us. It's a quarterly survey of CEOs, and what does it measure?
Absolutely. This is our U.S. CEO confidence measure, and we basically partner with the Business Council, and we ask CEOs, more than 150 of them, what are they thinking about the U.S. economy? So many of these CEOs are actually multinationals. So it's not just U.S. CEOs, it's a really broad spectrum of executives.
Wow. And these are some of the largest companies in the world. So these are, this is a pretty good barometer and has proven to be a good barometer of things to come over time, hasn't it?
Absolutely. And indeed, this survey was conducted between September 18th and October 2nd. And a lot has happened even between then. But I would imagine that some of the answers would probably still be the same.
Yeah. So what are the biggest takeaways from this survey?
So the biggest takeaway is the headline figure, where the gauge dipped to 46 now, from 48. And so a reading below 50 suggests that CEOs remain very cautious about what's ahead for the economy. Now, we're much less dour than we were earlier this year or even last year, but still CEOs are looking askance at the outlook here. But even within that, there's a lot of dichotomies and some cognitive dissonance. For example, CEOs think that the overall business environment will be worse than the business environment for their industry. Also, many CEOs said that, or rather fewer of them expect that there's going to be a short and shallow recession. And still a large percentage, but significantly lower than what we saw at the start of this year.
Yeah, so at the start of this year, I mean, it was over 90%, right, of CEOs thought we were going to have a recession.
Yes, so it was roughly 95% thought that, and now we're down to about 71.
Yeah. So that's a big shift, but still 71% of the CEOs think we're going to have a recession, which really synchronizes with your forecast of a short and shallow recession beginning in 2024, right?
It does. I mean, it's still consistent with that call. But I think the key thing is that something that you've mentioned, Steve, is that some of the CEOs are getting tired of waiting for it. And certainly when we look at the hard data in the U.S., it has surprised to the upside, especially consumer spending. has been better than expected, even despite higher interest rates and very elevated inflation. And also the labor market has held up much better. And part of that is due to what CEOs are doing, which we can talk about in a minute.
Yeah, well, but this whole economic situation has been to try to tame inflation, and as you keep pointing out, 5.25% increase in the discount rate is huge in a very short period of time, and all in an attempt to cool that level of inflation. What do CEOs think? Is it working?
Well, we didn't ask them explicitly, is it working? But I can look at the hard data and tell you that yes, it's working, but it takes a while to filter through the system.
Yeah. So the cautious outlook then is being caused by what?
Well, when we ask CEOs what things are the biggest risks to their businesses, they listed cyber issues, so cyber attacks, cyber security, all things cyber, legal and regulatory uncertainty, and also financial and economic risks. The surprising thing is that geopolitics moved down to number 4. It had been higher. And I would imagine that if we asked the same survey today, that geopolitics would probably move up, just given, certainly the levels of discord within Washington, the heightened disagreements between the U.S. and China, and of course, the Israel-Hamas war, which broke out really in the last week. So I would imagine that would rise to the top. But it's really interesting that businesses are very concerned about technological risks and regulatory issues.
Yeah, I was a little surprised about that, honestly, because typically you don't hear people talking about regulation as a primary risk. It's always out there, but it's usually lower. Cyber you kind of get, right, because that's front and center. Everybody's dealing with phishing and everything else, and it can shut down businesses and so forth. But really regulatory, which is controlled by government entities, putting rules around business. And now they're saying that that's the second biggest threat that they face.
Yes, I think it has to do with, some of it's probably the energy transition. Some of it's always, you always have regulations, and certainly there's been a lot of investment by the government in infrastructure and R&D, but you still need permits and patents for all those things. And certainly I would imagine, like, during the time of the survey, we were staring down a possible federal government shutdown. And when that happens, that causes disruptions in permitting and that sort of thing. So maybe that's part of it. But yeah, I found that to be surprising as well.
Yeah. And our public policy center, the Committee for Economic Development, obviously is going to take note of that. And I think there needs to be discussion between business and regulatory agencies on that, and what does it mean and so forth. So Dana, as you look at the survey results, is there consistency regarding how CEOs think about the health of the business in their industry relative to others?
Yes, it's really interesting. In the current conditions, they were certainly less optimistic about the general business environment, but they were more optimistic about what's going on in their own industry. So it's always this thing like, everyone else is going to be worse off than I am. And so I think that's really fascinating. And it was similar for expectations, where businesses or CEOs believe that their own industry would outperform relative to all other industries.
It actually is a very interesting thing. I've been around this survey for about 20 years, prior in my role as CEO prior to this. And typically people are more pessimistic about what they see more granularly than what they see in general, because they always think, oh, somebody else's business, they're doing better than I can do. But it's really the inverse here, which actually leads me to believe that if they're feeling really good about what they control, then that's actually, in my opinion, more relevant than what they're projecting about other people. What do you think?
I think that definitely is more relevant if you're more optimistic about your own industry and even your own company. But it suggests that companies don't and businesses don't work in a vacuum. So if you're still concerned about the external environment, then that should also give you some pause.
Okay, now labor markets are clearly very important to these CEOs. What are their thoughts on labor markets, and how does that mesh with their recession expectations?
So that's the interesting thing. CEOs have been calling, or many of them have been calling for some kind of recession, but they haven't been laying people off. And indeed, when we look at the share of companies saying that they're going to reduce workers, it fell from 20% to 13%. Meanwhile, you still have a large share, I think roughly 38% of companies that are saying they're still going to be hiring. And what's really outstanding in terms of it being very interesting is that those companies saying little change to their labor forces jumped from 40% to 49%. So that means that companies are still hiring those that, are still trying to catch up from the pandemic losses, or because they're having labor shortages, especially in manufacturing and construction, because you have these older workers retiring. But a ton of companies are just hoarding labor. They're just holding on to people because they think, well, if there is going to be a recession, it won't be that long, it won't be too bad, and we don't want to have to turn around 6 to 9 months later and try to rehire the people we let go. And then also, I think with somewhat fewer saying there's going to be a recession, there's no need for them to let people go. So hence we saw that movement of roughly 7 percentage points from net reduction in workforce to little change. So that's a sign of optimism there.
We discussed what CEOs are thinking now regarding the economy and the labor market. We're going to talk about what this means for our forecasting after a short break. We'll be right back.
Are you ready to transform your business and stay ahead of the competition? Artificial intelligence is quietly reshaping the global economy, optimizing manufacturing processes, and transforming how users interact with popular platforms. Harnessing the power of AI can exponentially enhance your business's effectiveness and efficiency. However, navigating the risks associated with this transformative technology is critical. Privacy, integrity, the economy, and humanity are all at stake. That's why the Conference Board is your go-to resource for the expertise and foresight you need to leverage AI to its fullest potential and make strategic moves that propel your business forward. Unlock the possibilities AI offers your business. Visit tcb.org/AI today to access trusted insights for what's ahead and guidance on navigating the AI transformation.
Welcome back to CEO Perspectives. I'm your host, Steve Odland from the Conference Board, and I'm joined today by M Peterson, the Chief Economist of the Conference Board. Okay, so Dana, going back to our conversation before the break, what are you seeing CEOs do? What are CEOs saying about their plans to increase investment then?
Well, before we do that, I just want to make another point about the labor market. Even though more CEOs are hoarding workers, it comes at a cost. And indeed, 67% of CEOs, plus another 4%, anticipate that they're going to have to raise wages by more than 3 percentage points over the next year. And that's quite significant. And only a small percentage, only 3%, said that they're going to narrow those increases in wages. And so that's going to contribute to inflation if companies still feel the need that they need to have these elevated wages to hold on to their workers. And also when we ask them about what do you think about attracting and qualified labor, they still think that they're going to have issues. So all of this is still shaping up into an inflationary environment. But just going back to your question on capital spending, we have a little bit of a shift in the percentage of CEOs saying that they are going to increase their capital spending budgets. And I think that's also consistent with, somewhat fewer of them saying that a recession is coming. It's like, okay, well, it hasn't happened, so maybe we should start investing.
Yeah, it is interesting. This whole thing in the retail world, there's a concept called land banking. So, if you're building a lot of stores, you want to go buy the land in various places for future stores. I see this, it's a metaphor, but I kind of see it now with CEOs saying that they're going to skills bank. In other words, it's been so hard for the past several years through the pandemic to find specific skill sets, to find the people that they need to truly drive their business. And in a knowledge-based economy, that this is the core of most companies, that they're kind of banking skills. They're holding on to people. They're moving them around. They're building things. So the human capital aspects of this has been really fascinating to watch.
Yes, and there are a few drivers there. Again, one big driver is the retirement of your older, more experienced workers. So the key thing is, well, let's try to hold on to some of them. Maybe they'll stick around longer. And then also let's get them to train the younger folks, train them up, as you always say, Steve, to get them to the level such that they can sustain the labor force. And then there's also technological advancement. Like when we ask CEOs and executives in our big annual C-Suite Outlook survey, digital transformation and automation always rise to the top. And so companies are trying to figure out how to use technology to do the more mundane tasks and then elevate their workers to either do something different or something more interesting, more creative to help build productivity for the company.
Yeah, it's a really important thing. If you can get more sales, more revenue, more profits out of your existing employee base, your existing investment base, you clearly will expand margins and grow the company. And that is, every little company is a tiny piece of what you've described as total factor productivity on a global basis. It all adds up. So, but you see this at a micro level when CEOs are trying to get more productivity out of their existing workforce.
Yes.
Go back to geopolitics, because that, now obviously we ended the survey before the Israel-Hamas situation, but talk about geopolitics and how that impacts CEOs' view of the world.
Yeah, I mean, I would imagine that if you're a CEO and you're looking at a world that's becoming multipolar, meaning you have countries allying with each other, that's a challenge for you because now you have to figure out a whole new set of regulations. You have to figure out a whole new game of trade. And in certain cases, for example, with BRICS, they're encouraging use of other currencies than the dollar. So that means that causes frictions in terms of your payments and your transactions. All this is very confusing. It's very expensive. And certainly for companies, between geopolitics and the disruptions in supply chains from the war, in Ukraine, and also from the pandemic itself, they're saying to themselves, well, I'm going to need to build up contingencies. That means building out redundancies and more supply chains, or bringing things home, or stockpiling, and all these things are expensive, but it's protections that businesses are having to build into how they operate, just given the fact that there's so many uncertainties out there, and a lot of it is driven by geopolitics.
Yeah, and you said multipolar, but it's almost becoming bipolar with, and that has different meanings. But right, I mean, it's the BRICS, which is expanding, as we know, in just a couple months here by 5 more nations versus the West. I mean, it's turning into military and trading blocks.
Yes, indeed. And if you're a company, that's a challenge, especially if it restricts free trade, if it also means complications with having to use different currencies, if it means that certain economies are no longer going to be friendly to foreign investment. All of those are barriers to being a great productive company.
Yeah, and I suppose it depends, the great answer. Well, the answer is it depends. But it depends on where these companies have their supply chains and where they have their customer bases, right? So if they are not in these risky areas, then they are probably more confident than if they're heavily dependent on these areas.
That's true. And so in some cases, companies may have to divest and focus on core areas, but it's hard to do when you think about an economy like China, where you have, 1.5 billion people, and they're shifting into being in the middle class and want to consume. That's really tantalizing, and it's very difficult to think about pulling out. And also, when you think about production, there's a reason why China is the world's manufacturing factory floor. It's because they have the labor and the technology. So all of those things make it very difficult for businesses to have to make these hard decisions, but sometimes you just do.
Well, you're exactly right. You and I have had this conversation about chips, for example. Why are they all in Taiwan? Why don't they just move those factories? Well, those factories can cost $1 billion to move, and it's very difficult to start up and get the productivity and everything. So you can't just snap your fingers. These are sort of decades long kind of processes, right?
Absolutely.
Yeah. So against this economic backdrop, how many more rate hikes do CEOs think that the U.S. Fed will deliver to us?
Well, 52% expect one more, and then 24% expect two, and then that's pretty much it. And then, but a sizable 22% or 1/5 say that the Fed is done. And the thing is that I think that there's justification for all of these. Certainly, the Fed has indicated that back in September at its last meeting that there was one more hike to go. But then this last week, we heard from Lori Logan, who's the president of the Dallas Fed, and also Vice Chair Jefferson from the board of governors, gave out some really dovish commentary where they said maybe the run up in bond yields will do some of the work for the Fed, and people interpreted that as maybe there isn't another rate hike. But we also received CPI data this morning, and frankly, it's not all going in the right direction. We still have a lot of inflation. We saw a massive number of people hired in September. And also, when you think about GDP growth for the third quarter, we're beyond the third quarter, but it was we're looking at 3 or 4 handle, and some people even have a 5 handle on growth. So with all of that suggests that the Fed will probably need to come back. But we shall see. There are 2 more meetings, November and December, before the year is out.
And so you expect them still to raise rates by 25 basis points one more time, right?
Yes, that's correct.
Yeah. Okay. Any other highlights you'd like to share?
We also asked about when the Fed will start cutting interest rates. And the thing is that 57% of CEOs believe the Fed will start cutting rates in the second half of 2024. And that's actually later than what the consensus is among a lot of economists and even markets, which have been pricing in rate cuts as soon as the first half of the year. Our own forecast is probably late in the second quarter, so that's roughly around the middle of next year. But for the most part, many CEOs are not expecting any cutting until the second half, or even later. 28% have 2025 or later. And that's actually not out of bounds with what the Fed itself is saying, where the Fed only has 2 rate cuts priced in for next year. And they're saying that interest rates will probably have to be higher for longer. So maybe that does sync up with second half. But again, we shall see.
So it's interesting that economists are kind of leaning one way, CEOs are leaning another way. And the Conference Board is sitting kind of right in the middle. And I will remind our listeners that the Conference Board's forecasting of economics has won awards for its accuracies. And Dana, I'm putting my money on your forecast.
Thanks, Steve.
Dana, great to be with you today.
Absolutely. Always a pleasure.
And thanks to all of you for listening into CEO Perspectives. Every week, I'll be joined by a prominent thought leader to provide insights on the issues of our time. We'll cover the leading topics in geopolitics, economics, public policy, and more. Please share CEO Perspectives with your colleagues, with your friends, with everybody you know. I know they're going to want to listen. I'm Steve Odland, and this series has been brought to you by the Conference Board.
You have been listening to CEO Perspectives, a podcast by the Conference Board.